Okay, we are looking at the second lecture for Chapter 10 for auditing. We kind of stopped here last time with identifying control risks. Kind of talked through this slide already, but we need to understand, how it works and how we identify those control risks and what processes we do to understand the controls. And we also look not only at entity-wide controls, also transactional controls, and then any significant control activities related to cash. Okay. All right. So this is on page 502. The last part was on page 501. So some questionnaires, and I'm not going to read through all these, but if you do, you can pause this video and read through it yourself. But just kind of my 2 cents about this is that the questionnaires, they give you generic ones. You will have generic ones to use usually as an auditor, but the better you understand the organization, the more you can tailor these types of questions to exactly who it is you're auditing, what it is they do, how their business actually works. This is why we talked a few chapters ago about understanding what a business does and how it works, and kind of just knowing that business before you ever actually go out and perform the audit. This is why that's so important, because while I can have some of these questions will work for almost every organization, and I can have kind of generic questions, I should also have more questions based on answers, and I also need to have an understanding going in so that I need to know what do they even use a lockbox. Okay, chapter number 6 there talks about a lockbox. If I don't know that going in, then that's just going to be a waste of my time to ask that question in the first place. So read through these and just understand that they would be a little different for each place, but still really similar and kind of all along these lines. All right, typical controls over cash, again, it's on page 502. Segregation of duties, probably the number one. Okay, the fact that you shouldn't have the same individuals responsible for recording the cash that opens the checks. The same person, there should be at least a different person who opens the checks, that receives them, a different person who is responsible for filling out the deposit slip and taking it physically to the bank, and a different person who's responsible for recording it. If you do all 3 of those, that's the easiest way to potentially have a fraudulent activity, because if you have all the control over the cash at every step of the way, it's the easiest way to hide and cover your tracks. Restrictive endorsements of customer checks. So maybe only certain people can endorse certain checks, okay, to be deposited. That could have to do with, the size of the check. Could be only the person maybe who's responsible for the sale. There's all different ways to do this, but if you separate who can actually sign something for it to be deposited, then you can effectively make the check go through another individual before it actually reaches the bank. Independent bank reconciliation by employees who do not handle cash. The bank rec should be done on a regular basis. Depends on the company. Could be done weekly, could be done monthly, but it should be done on a regular basis, and it should be done by someone who is not responsible for it. Because again, it's another spot that fraud could be caught if it's not the person who's actually performing the reconciliation. Computerized control, totals and edit checks, making sure that the total checks that came in is the totals on the deposit and that everything matches up. Authorization of transactions. Whenever a transaction occurs, depending on what that transaction is, there's oftentimes an authorization. This could be electronic or physical. Physical would be something like requiring a signature for any checks over a certain dollar amount. An example of an electronic one, well, for example, we're enrolling right now, and I have to authorize you to be able to enroll as a student for online enrollment. That's an authorization. It's not a transaction, but it's enrollment. So it has to go through me in order for that to happen. Same kind of thing here. So you can't send a check out, or you can't create an invoice, or you can't, reduce someone's receivable without authorization. Pre-numbered documents and turnaround documents. Pre-numbered documents, we've talked about that a little bit. But we know that if I have checks, a check number is an easy one, and there's one missing, I can try and figure out why. Pre-number, okay, periodic internal audits and competent and well-trained employees. Move on. So what happens if these internal controls are not effective? Controls related to the existence assertion, should provide reasonable assurance that the cash balances include on the financial statement actually exist, okay, and cash is not materially overstated. So the best way to do that, again, is with an external confirmation sent to the bank. We can look at bank statements, but those are easier to falsify than an actual third party sending us the information. Controls related to completeness provide a reasonable assurance that all valid cash transactions are recorded, making sure that the ledger is complete. Everything that did happen is there. There's not something hiding or something that was not recorded that did actually occur. Okay, controls for petty cash. And this is on page 507. Remember, petty cash is that amount of cash we have somewhere on site, usually, that is for small, relatively insignificant cash transactions that need to occur on a regular basis. Anything from needing to, really desperately needing some office supply down at the store to ordering donuts for the office. It depends on the company, what their policies are, but that's the type of thing petty cash is used for. Access to it, number one. It should be somewhere locked up, and only one or two individuals, whoever is responsible for it, should be able to get into it. Requiring receipts. So when you do petty cash transactions, how it would typically work is whoever's responsible for it would open up the petty cash drawer, box, or whatever, safe, depends on what it is, and they would take the cash out and give it to whoever needs it, before they go into say the office supply store. Then that person would come back and give a receipt. So let's say I gave you 20 bucks to go down and buy paper, copier paper or something, and it costs $15.75. What should happen is that individual should be responsible to come back and bring me the receipt and the change. So I should get a receipt that says it costs $15.75, and I should also get $4.25 back. That's what we used to reconcile the petty cash fund and replenish. We did this in financial accounting when we would go to the bank and replenish the petty cash fund. And we did the journalizing of that and the math side. Doesn't always match. Remember, we have cash over short, but hopefully it's either close or it should match if everything's done correctly. And then you can conduct periodic surprise audits of petty cash too. I don't see that done very often because petty cash is usually by definition a pretty low dollar amount, but you still don't want anyone stealing from you. It doesn't really matter how much it is. Stealing is stealing. And a lot of times too, when you see things like petty cash going missing, then you can think that it's likely that other places might have things missing too. Okay. Controls and cash management techniques on page 507. Electronic funds transfers. This is when a supplier, customer, or banks, they can basically have an automated or electronic way to transfer money from one to the other rather than actually writing checks. There still needs to be a reconciliation between what you were supposed to receive and what you actually received. But there should also still be documentation, maybe not physical documentation, but within the computer. You should be able to go through and see what steps it took in the process, what the authorization process was, all the different elements that you need to know to audit as if it were a paper transaction or a check transaction. So for example, EFTs a lot of times will actually have numbers associated with them, just so you still have a pre-numbered type, similar to checks, pre-numbered document, just not a document, okay, pre-numbered. So every EFT, might have a number associated with it. So then you could look and say, okay, well, every EFT this year we went from 1,200 at the beginning of the year, and at the end of the year we were at 2,000. So you should have 800 EFT transactions. There shouldn't be any missing. It shouldn't be, it should be just like checks. It can be. It's one option for a control. Cash management agreements with financial institutions. A lot of times, companies will allow financial institutions to use their money that's in the bank for other things. Why? Because idle cash doesn't earn any money. So leaving my cash somewhere, even overnight, that money's not doing anything. Whereas if they clean it out every night, or maybe just weekly, maybe once a week, and invest it somewhere even for a weekend, and for you and me and most regular individuals, the amount of money that we have in our checking or savings account isn't enough to really warrant moving it for 24 or 48 hours. But you think about some big companies that could have hundreds of thousands or millions of dollars in a bank, at a given time. Moving that out over the weekend could actually change, could be a substantial amount of money, especially if you do it every weekend all year round. But there can also be risk involved with that. When that is moved out, where does it go? And is there risk of it being lost when it's not in the account? Okay. Documentation of controls. So the auditor needs to document an understanding of the controls for both integrated audits and financial statement audits. And we'll look at the questionnaire here on the next page on Exhibit 10.3. But this is a questionnaire very similar to ones that I used when I was auditing. And again, it was just general rules, steps, things that you do in order to confirm that the controls are not only in place, but also working and being utilized as they're intended to do. We talked about how it doesn't really matter how good your internal control system is if it's not being utilized well, if it's not being actually put into place, if it's not being, if the correct actions are not being taken. So the questionnaire is supposed to guide you in documenting your understanding of the controls, because just like everything else in an audit, controls also need to be documented just as much as the other financial statement aspects. And the other thing this does is it kind of gives you a visual understanding of what the internal control system is like and how it's used. So if there's a negative answer in the questionnaire, this represents a potential internal control deficiency, which would raise up our control risk. And this alerts the auditor that they need to consider the effect in the initial assessment of control risk. So again, I'm not going to read through all these. I do recommend you read through them, and I wouldn't say you have to read every single one, but just kind of get a good idea of what they're about and what they're doing. So it talks about the procedures for cash remittance. Okay, we're talking about incoming receipts by the person who opens the remittance and who delivers the list to a person independent of the deposit function. So this is just quite literally going step by step into what a separation of duties is for cash remittances. And same thing for most of the rest of them. It's mostly about separation of duties as well as authorization controls and who can do what, and more than one person involved, and where does my risk lie. And then you see at the end there, and this is on page 508 and 509, at the end you see that we can put low or high control risk for the cash itself. So read through these and you just notice, you check mark or mark whether they were in place and being used and how it was being done. All right, move on from these. Okay, page 510, performing analytical procedures. This helps identify areas of potential misstatements when you're planning the audit in the first place. Remember, we do analytical procedures throughout, but one of the largest as far as time consuming and most analytical procedures are done in the planning stages of the audit. This is done before we ever go out there. This is comparing, contrasting beginning balances versus ending balances, financial statements from year to year, operational budgets, budgetary forecast, and then specifically we're talking about cash right now. So I'd want to look at those, the cash budget with regard to that and see, were they on track and would it be where we anticipated it being. This requires awareness of the importance of cash balance and debt covenants. We talked about debt covenants in the last video. Remember what those were. Because remember, that is something that could really harm a company if a bank decides that, I shouldn't say decides, the debt covenant is contractual. If the debt covenant is broken, then the bank has the right to decide to call that loan immediately. Okay, some examples of the transaction analysis and account balance ratios. We're going to compare monthly cash balances with past years and budgets, identify if there's any unexpected spikes or lows in the cash, compute trends, interest, things like that. So if I've got an account that has a given interest rate, and I don't have to necessarily look at the daily balance, but if I have a beginning and an ending balance, let's say it didn't move too much throughout the year, which means money was probably going in and out at a relatively regular rate, I could figure, what the interest should be for the year and compare whether the interest that was shown for interest revenue in this case was roughly that. And if there was a material difference, I might have to go continue looking further, but that would be one method I could use to at least do an analytical procedure for this. Analyzing cash balances and changes therein in relation to new or retiring debt obligations, and so on and so forth. You can read through the rest of those. All right, relationships for cash accounts. Actually, we're just about the 15-minute mark, so I think I'm going to stop there again for now.